Okay, let's dive right into this explainer. We're going to unpack how Stewart Information Services navigated a genuinely tough, stalled real estate market by doing something kind of radical, heavily aligning their executive pay directly to actual performance. We're basically looking under the hood of their corporate governance to see exactly how human incentives drive financial reality.
Here's our roadmap. We'll cover the title insurance landscape, look inside Stewart Information Services, check out their at-risk pay philosophy, see why it's margin over everything, break down their Q1 2026 earnings, and finally look at valuation and the bottom line. Let's get into it.
Number 1. The title insurance landscape.
So $4.9 billion. That staggering number represents the total premiums generated by the entire title insurance industry in just the third quarter of 2025 alone. ALTA, the American Land Title Association, reported this as a 14.2% jump compared to the exact same period the previous year. So honestly, even with high mortgage rates putting a serious drag on the housing market, there is still a massive multi-billion-dollar pie up for grabs here.
And within this incredibly lucrative, cutthroat landscape, Stewart holds the number 5 spot. They command a solid 11.1% of the total market share, sitting right behind heavyweights like First American and Fidelity. Now, to grow, or frankly, even just to hold on to that slice of the pie, requires intense, relentless operational discipline.
Section 2. Inside Stewart Information Services.
So how exactly does leadership steer the ship when the macro environment is actively fighting them with fluctuating interest rates and affordability constraints? Well, that brings us right to their official STC proxy statement ahead of the May 2026 annual meeting, signed off by Corporate Secretary Elizabeth K. Giddens. Now, this isn't just dry bureaucratic paperwork, it's the playbook. It reveals the core mechanics of the company and exactly what metrics the board of directors actually care about to drive growth.
Number 3. The at-risk pay philosophy.
You know the old saying, right? Show me the incentive and I'll show you the outcome? Well, Stewart's board of directors has taken this to heart in a major way. Their strict pay-for-performance philosophy is brilliant because of how extreme it is. A massive 85% of CEO Frederick Eppinger's total target compensation is entirely at risk, meaning only 15% is his guaranteed base salary. His financial upside is completely locked in with the company's financial upside. If Stewart struggles, well, his paycheck shrinks. He literally only gets paid big if the company performs big.
Section 4. Margin over everything.
Okay, the absolute crucial point here is understanding exactly which metrics the executives actually need to hit to earn that variable pay, because that is what the CEO is going to wake up and focus on every single day. Under their short-term incentive plan, the board made a fascinating choice. A staggering 80% of the financial goal weighting is tied directly to corporate pre-tax margin, while only 20% goes to corporate net revenue. This reflects a laser-sharp focus on operational efficiency. They don't just want volume, they want profitable volume. It is literally margin over everything.
So, let's look at the actual results. Did the incentive work? Absolutely. The executives completely blew past their targets in 2025. Their target for pre-tax margin was around 5%, but they actually pulled off a 5.6% margin. They also beat their net revenue target by over $100 million. This, of course, drove over-target bonus payouts for the entire leadership team.
And this pay versus performance alignment worked exactly the way it was supposed to. Just look at this. From 2024 to 2025, the company's net income grew from $158 million to nearly $170 million. And in lockstep with that success, the CEO's realized compensation grew from $6.2 million to $8 million. It's pretty much a textbook example of a compensation plan functioning exactly how shareholders dream it will.
Number 5. Q1 2026 earnings breakdown.
Let's fast forward to the immediate outcome of this intense operational focus and check out the financial results that just rolled in. Wall Street analysts looked at the messy macro environment and estimated Stewart would bring in 52 cents per share. But Stewart absolutely crushed that, delivering 78 cents per share. I mean, that is a massive outperformance that caught analysts completely off guard.
And the crazy part? They didn't just beat on the bottom line earnings. They also completely crushed top-line revenue expectations. In Q1, revenue surged 27.7% year over year, pulling in over $778 million in a quarter, where analysts were barely expecting $730 million. This kind of double beat on both top and bottom lines is exactly what you want to see when a company is running a lean, high-margin operation.
Finally, Section 6, Valuation and the bottom line.
So, we've seen the incentives and we've seen the impressive quarterly results. But what does this actually mean for the underlying long-term value of the company itself? To answer that, we have to look at book value per share,
or BVPS. Since insurers are fundamentally balance sheet businesses, BVPS is kind of our ultimate truth teller for long-term capital growth. It strips away all that one-time earnings noise and just shows us the actual unmanipulated residual value left over for the shareholders.
Right now, Stewart's fundamentals are looking remarkably strong. Their book value per share has grown to $53.84, which represents a really steady 4.6% annual growth over the last 2 years. Pair that with a super reasonable P ratio of 14.67 and an expected EPS growth of over 17% next year, and it becomes pretty clear. Their aggressive, pay-for-performance culture isn't just making executives rich, it is directly translating into fundamental shareholder value.
I'm going to leave you with this final thought to chew on. We just saw how meticulously tying a CEO's livelihood directly to pre-tax margin propelled Stewart Information Services to a massive quarterly beat, all despite some very real macroeconomic headwinds. If human incentives fundamentally shape corporate reality, should we be demanding this level of aggressive alignment from every single company we invest in? It's a fascinating question. Thanks for joining me on this explainer, and I'll catch you on the next one.